Hello, I'm Ben. I'm a finance professor. In this video, we're going to talk about which industries are the most undervalued right now. To do that, I'm going to look at 4 different metrics which gauge which industries are the most undervalued. Then within those 4 metrics, I'll take the top 3 industries as most undervalued, and at the end, I'll count up which industries showed up on the most top 3 lists. Those will be the ones which are the most undervalued. First, I look at industries with the highest percentage of buy ratings by Wall Street analysts as of June 17th, 2022. A buy rating is the highest rating an analyst can give a firm. The 2 lower ratings would be hold or sell. As a baseline in the market as a whole, 57% of firms have a buy rating. So which industries have the highest percentage of firms with a buy rating? Information technology, energy, and communication services all have more than 60% of firms with a buy rating. So these are the most undervalued firms in terms of the first metric. Just so you know, the industry with the lowest percentage of firms with a buy rating is consumer staples, with only 39% of firms having a buy rating. The second metric we'll consider is the 2022 earnings growth, or how fast are profits growing in 2022 compared to 2021. We know that profits are one of the largest determinants of stock prices, so higher profits means higher stock price. So which industries have the fastest growing profits? Energy, industrials, and materials all have 2022 expected profits more than 15% larger than 2021 profits. The industry with the lowest profit growth is financials. Its profits are actually expected to decline 11% in 2022 relative to 2021. So financial firm profits will be smaller this year than last year, if expectations are correct. The third metric we'll consider is the forward PE ratio, which is the current price divided by the next 4 quarters expected earnings. As far as this metric goes, the lower the PE, the more undervalued the industry. The 3 industries with the lowest forward PE are financials, energy, and materials. All have PE ratios below 13. Just so you know, the industry with the highest PE is consumer discretionary with a PE of 22. Finally, the 4th metric to gauge the most undervalued industries is the target price closing price ratio. This is just the average 12-month target prices of Wall Street analysts divided by the closing or current price. For example, if Wall Street analysts expect a firm's price to be 150 12 months from now, and the firm's closing price is currently 100, the target price to closing price ratio would just be 150 divided by 100, or 1.5. In this example, the 1.5 implies the stock should increase in price by 50% in the next 12 months, so higher is better. We want more price appreciation, not less. The industries with the highest target price to closing price ratio are communication services, consumer discretionary, and information technology. All have target prices at least 40% larger than their current closing price. Just so you know, the industry with the lowest ratio is consumer staples. To conclude, energy showed up on 3 lists, while information technology, communication services, and materials all showed up on 2 lists. So those are the most undervalued industries, first tier and second tier. Thank you very much for watching. If you thought this was valuable, please punch the like button below, and I'll see you in the next video.